Well, we'll go ahead and get started. Good morning, everyone, and thank you for joining our webinar, Ballots and Balance Sheets. Today, we will be discussing the upcoming election and potential impacts for the markets. My name is Ken Stansberry. I'm with Cornerstone Financial Group. We also have with us Andy Brzezinska, a partner with PWM out of St. Louis. And what we thought we would do is we would start off with a question for each of us. I'll go first and ask Andy a question, and then he'll ask me a question. We'll get to Blake. So Andy, this race has been so polarizing. It can be really hard to sort through the noise that's coming through seemingly from every direction. When you boil it all down, though, what do you think could be the most impactful for our clients' financial lives from this election?
It's a great question, Ken. I don't think I could have written that better myself. Hi, everyone. Thanks for taking your time to join us today. And you're right. I mean, it's I feel like one of the most polarizing elections we've had in a long time. And so the factor, what gets very hard is filtering through all the noise that's out there from all the sources of media and figuring out, when you get down to it, how is this actually going to impact you? And so, frequently during this time, you get a lot of rhetoric out there about changes in policy that are going to be made and all of these things that are going to happen during election season. I think if we all reflect back, that's pretty consistent election to election. And then you go and you look the next year or next 2 years, sometimes the next 4 years, very little of that policy actually gets enacted. And so, with that being the challenge, one thing does kind of stick out to us as potentially being pretty impactful for some clients, and that's the tax law. So the way that the current tax law is set up is that there's a sunset provision on it. So if whatever the makeup of our new government doesn't do anything, which I think, given the track record, is a pretty reasonable expectation and is probably a pretty likely scenario, the current law is set to sunset at the end of 2025.
Did it work?
Okay,
good. Oh.
And carries. And so with that sunset, everything would revert back to the law that was put in place prior to 2018. So the law that was in place in 2017. And so some of those changes that we're looking at are a change in the tax brackets themselves. And when you look at the brackets, they actually have a pretty significant impact when you're in that 24% bracket in today's. And Andre, could you maybe move over to the next slide for me? There we go. Thank you. So that 24% bracket would be the one that would have the most impact from a taxable income standpoint. So as you can see, for a joint filer, that 24% bracket is today, it's between $201,000 and $383,000. But if the law sunsets and the prior law is back in place, that 24% income gets spread out. Some of it occurs at the 28% bracket, so 4% higher than where we're at today. But the bulk of it jumps up to 33%, so 9% increase there. And so, now there are several other changes that are out there that should help offset this. And so we've got a couple slides that summarize all those. And so one thought I had was to just sit with you guys today and just break down every single one of these. Settle in. We'll go for an hour or two breaking all these down. I don't think that's what you're here for. So on a broad perspective, what I think my big message is, this is very depending on your situation. The new tax law could hurt you in 2026, or the new old tax law could benefit you starting in 2026. But it's a very personal thing. And so what we have the ability to do both at PWM and Cornerstone is help you identify if the new law is going to have a negative or positive impact on you. And so, my call to action really is just to say, sit down with us, give us the opportunity to do a tax analysis, and we'll be able to help you identify, A, if it's going to hurt you or help you, and B, what types of strategies we may recommend putting in place given that potential change. And so ultimately the tax piece, really because there's no action that's needed for the taxes to change. No new laws have to be passed for the tax law to change. To us, that's probably one of the most significant potential impacts that could be coming from an election perspective over the next year. And so with that being said, Ken, I'm going to bounce it back to you and your experience with being more involved on the local and with local politics. And so maybe can you tell us a bit as far as what you've seen on the local side and maybe how that differs, what goes on locally versus what these national elections mean?
Yeah, Andy, thank you. Great information. I've had the pleasure of serving as a council member in Youngsville, the city of Youngsville, for almost 9 years. I'm currently a Lafayette Parish council member for District 3. I'm in my first year. And our work is really focused on practical, immediate solutions that directly impact the community. What does that mean? Well, it's roads, drainage, water, sewer, parks. Many of these things focus on quality of life for our citizens. And now, being on the parish council, I get the fun job of appointing folks to various boards, sometimes the most contentious part of my job. But the decisions that we tend to have more of an immediate visible effect. They're often less bureaucracy to navigate these compared to the national politics. However, where we do work together, in my experience, a lot of these big projects, road projects, sometimes for us in Louisiana, DOTD, working together, state, local funds, we're getting funds from the state and federal dollars for those big projects. But it's on the local officials. I know at the state level, we worked with several state reps when they're asking for, hey, what are your priorities? Talking to the mayor, the council, the mayor president. So it's really a big teamwork going on. The big difference though at the state and national level is those districts are so large and you have everyone fighting over the same dollar. So it does become very competitive, and a lot of times these elected officials are voting for something they don't want to get something they do want. So they have to compromise. The local level, it's just it's not as cumbersome through that. So, and I would like to add, having been a financial advisor over the last 17 years, I've been through several elections and I've had many interactions with clients. And like Andy was saying, and what we've been talking about, oftentimes this is where emotions run the highest. It's a lot of the social issues. And we have had many conversations around portfolio allocation. Several conversations about, should I go to cash until the end, until after the election? Well, today, we have the pleasure brought in one of our external partners, Blake Nystrom. He's a vice president with First Trust, and he's going to discuss further the data surrounding elections and their impact on the market. This information's been high demand, so we're very grateful that Blake was able to make time for us today. And Blake, I'll turn it over to you. Thank you so much for being here.
Awesome. Thanks, Ken. Appreciate the introduction. I'm going to share my screen. Or Andre, if you can pass that back to me so I can share my screen here in a minute, that'd be great. Yeah, really appreciate the opportunity to be here with y'all today. you know, my role in my job is I work with financial advisors all over the state of Louisiana. I work for an asset manager uh, based out of the Chicago suburbs called First Trust. Can y'all see my screen all right, Ken? Is it up yet? Here we go. Good now? Awesome. So I work for an asset manager based out of the Chicago suburbs called First Trust Portfolios. We're a private company, one that you know has been a consistently high ranked in terms of our market and economic commentary, and just something that a firm that really works to serve financial advisors across the country. My role here in Louisiana to do just that. So, you know, one of the most difficult things I think about this current market environment that we're in, and it's always been like this, but maybe more so even now, is that there is so much information out there for all of you to sift through, right? Depending upon which news station you listen to or who you follow on Twitter or all these different things coming at you with all sorts of different data. There's hundreds of asset managers, there's forecasters, there's prognosticators. And a lot of times these people are looking at all the same information and then spinning that into whatever narrative they want you to think about, right? And there's no place that's more relevant than in politics. So I think what the team here at Cornerstone does a really good job of is sifting through that, trying to figure out what are the pieces that are relevant and how those impact all of your financial plans. And that's really why I'm here today. You know, one of the major resources they use is our economic and market research team, led by our chief economist Brian Westbury. What you know, my CEO, his name's Jim Bowen, conservative guy, owns 51% of the company, a private company. What we've said from the beginning is that we want to focus on data and tell you what we think based on what we're seeing, not what we want to happen, not what we hope happens, not what our feelings tell us, but based on what we see in the current environment. Where do we think things are going from an economic perspective, from a market perspective, and also from a political perspective, as all these things tie in together. So what I want to share here today is I will give you an update just on what our team is thinking as it relates to the election. But then also I'm gonna spend some time going through just some of the data and what the actual numbers tell you about what it means to invest based on who's in office, right? And it may surprise a few people as well. So I'll just start with kind of our forecast, right? So our deputy chief economist is a guy by the name of Bob Stein. He spent time on the Senate Budget Committee for many years. He lives in Virginia. He's very plugged into Washington, has a lot of connections there. He's been with First Trust for about 20 years. And so he is really an expert at looking at the polling data, what's all the things that we can kind of garner from what the market is telling us about what's going to happen with the election, right? So there's really two major areas he's looked at. Of course, who we think is going to become the president and what's going to happen in Congress. So I'll start with his highest conviction thoughts right now, and that is that there's a 90% chance that the GOP takes control of the Senate. Okay. The main reason is it really comes down to what seats are available or what seats are up and what aren't. So I think there's a very good chance that the Republicans take West Virginia and likely Ohio and Montana as well. That would put them at 52 states, even if the Dems continue to pull away in places like Pennsylvania, Wisconsin, Michigan. The reason why who wins the Senate, who wins Congress is important is that there actually is an impact on how markets perform based on the makeup of the presidency and Congress, right? So point one, we think there's about a 90% chance that Republicans will control the Senate at the end of this election. Now let's talk a little bit more about the presidential election. So Bob gives Trump about a 65% chance to win the presidential election at this point. He took that up from 60% about a week ago. And the main reason for that is just what we're seeing in the polls right now. So Trump has traditionally, in his last two election cycles, he's done better at the ballot box than in the polls. So we think that Harris needs about a 3% lead in the polls going into the election to make this a 50-50 toss-up. She's at 1% right now. So we think that favors Trump. We also think that he has about a 2% better chance in the Electoral College, even if he wasn't to win the popular vote. So what does that mean across the board when we talk about the makeup of president and Congress. Well, with Trump at a 65% chance to win, we think that means there's about a 50% chance of a GOP sweep. So that means Republicans taking the presidency, the Senate, and the House. We give a Trump win with a GOP Senate and a Democratic House at about 15%, a Harris win and a Republican Senate at 25%, and a Democratic sweep at about 10%. The reason why some of those numbers are a little bit lower is that over the last 40 years, in an increasing way, the House of Representatives has tended to go with whoever wins the presidency. So that's why you see a 50% chance of a GOP sweep and a 10% chance of a Dem sweep. That really comes down to our strong conviction that Republicans will take the Senate, and an increasingly stronger conviction that Trump will take the presidency. Now, I say all that just as a backdrop. People want to know these things. These are not my opinions. I'm just a wholesaler in Louisiana, but our smartest people that really are plugged in, this is what they think. So we'll see. Now, what that means for your investment portfolios, I think, is actually pretty interesting. I mean, who wins the presidency absolutely matters. It matters from a policy perspective. You know, Andy touched on taxes. That's absolutely a huge impact. The local level, I mean, who wins political elections absolutely matters. But how much does it really matter for your investment portfolio? And that's what I want to spend the rest of our time with here today. Let's just look at some of the data in terms of how the market has performed in different election years and based on who's in the presidency, right? So in presidential election years, on average, going back to 1928, the market is up about 8.5% when a Democrat was elected, and about 15% when a Republican was elected. Up on average about 11.5% in all years. We're seeing that again this year. I mean, having another strong year in the S&P 500, the Dow, we're setting all kinds of new records. So this kind of keeps with, you know, the general trend is that in election years, the market tends to do pretty well. So a lot of positives here, right? In about 20 of 24 years, the market's positive. What I also think is interesting is, you know, when a Democrat is in office, which is currently the case, Joe Biden is still the president. Whether he shows up or not is always interesting, but he is the president. The total return in the market is positive pretty substantially the next year, whether a Democrat or a Republican was elected. So when I see numbers like this, it always gives me some, you know, some good feelings that we can have strong years either way, right? So, I mean, that data would tell us that maybe a Republican president is best. Well, let's actually look at the returns of the S&P 500 in the first year of a 4-year presidential term. Kind of interesting here, right? Dating back to 1977, Democrats, when a Democrat is the president, the market's up on average about 20% in the first year of the presidential term. And when a Republican is president, it's up about 12.3%. So is it better to have a Democratic president? Well, let's keep digging a little bit deeper. What happens with a new versus reelected president since dating back to 1928? But when a new president is voted in, the market's up on average about 12.5% the following year. When a president's reelected, it's up about 7.5%, and in all years, it's up about 10%. Well, this one is off, right? We're not going to have a reelected president. Joe Biden has dropped out of the race. So, you know, probably we can feel pretty good that regardless of who it is, we've got a decent chance that the market is going to do okay next year. All right. And then overall, you know, how does the market perform in a 4-year election cycle? I think this information is pretty interesting too. You know, in general, the third and fourth years of an election cycle tend to do best. And in 67 of the 92 years, there was positive performance. Now, this really just speaks more to the broader market, right? I really like this slide because in 67 of 92 years of the S&P 500 dating back to 1929, the market has been positive. That's great news, I think, for all of us to have, right? And that means we've been through all sorts of things: depressions, wars, different types of pandemics and global crises. And regardless, the market tends to go up and to the right. because of the resilience and the innovation of American business and individuals. It doesn't have a ton to do with who's in office and who isn't. And you can really see that. I mean, in fact, over this time frame, when a Republican was in office, the market was up on average about 8%. And with a Democrat, it was up on average about 15%. As someone personally that's more of a right-leaning type of individual, like that's pretty surprising to me. But overall, it's exciting to know that on average, the market is up. Sorry, I'm getting a little, but on average, over a 4-year term, the market's up about 46% in election cycles. So, most of the time, we can feel pretty good about the next 4 years in the market, regardless of who's in office. Now, one thing that does play a role here, and that I think is worth considering, is the makeup of Congress and president, right? How does the market perform based on these different makeups? And that's why I kind of kicked off the presentation with this is in our opinion, this is the one thing that can have some impact on whether the market does not necessarily better or worse, but better or better, is the makeup of Congress, right? And this is simply because the market craves certainty over uncertainty, right? When we're less certain about what happens, there's more risk. People tend to be less convicted around what they want to do, and the market tends to not do quite as well. So what gives us more certainty in a president as far as a political perspective? Well, it's not having one house or one political party able to make more changes. And the easiest way for political parties to make changes is if the president, the Senate, and the House are all from the same political party, right? So let's look at this. In years where there's a Democratic president and a Republican Congress, the market's up on average 18.5%. With a Democratic president and a split Congress, the market's up about 18.1. And split could mean either it's just the Congress is split. So it could be a Republican Senate and a Democratic House, or vice versa. Similarly, with a Republican president and a split House, market's up about 17.6. So these are really your bigger return situations in which we do have some type of divided government. But the biggest thing to me when I look at this slide is that every single one of these numbers is positive, right? It's really compelling from a investor perspective to know that the market tends to be up regardless of what's going on in the federal political environment. And for that reason, I think it's super important to really sorry about that. It's too important to really just stick to your plan. You've got a great team here at Cornerstone with Ken and Andy and Dave and Andre and Eli and all these people that are there to really help you come up with a plan and stick to it. So let's put this into some dollars and cents perspective, something that I think all of us can really relate to. Let's say we invested $10,000 in the S&P 500 back in 1949 and then didn't touch it, right? This black line is fully invested. So from 1949 to 2024, that would be worth about $3.7 million, right? At $10,000, you just never touched it. Now, let's say you tried to make an investment decision based on who was the president, and you looked at only when a Republican was president, and you invested your money in the market in the S&P only when a Republican was the president, and when a Democrat was the president, you took your money out, you sat in cash. In that scenario, over that same time frame, you'd be up about $100,000, $200,000. And the same concept, but just Democrats, that number is about 400,000. So by no means is this saying it's twice as good when a Democrat is president. It's actually saying making an investment decision based on who the president of the United States is or which political party that person represents is an extremely difficult way to make money in the environment, in any environment. You have to time it on both ends. You have to, what all this tells us at First Trust is that the performance of your investment portfolios has much more to do with the plan you have in place with your advisor and the conditions of the market than who the president is. So much of what happens in the market is lagging indicators, and presidents don't have necessarily the amount of time that they're needed to make major changes that will have significant enough impacts where you should be pulling money in and out of the market. right? Um, two more quick slides, just a couple things to think about. I've said a lot about, it doesn't matter, don't worry about it. And I don't mean to be flippant. There are certainly ways that, investing based on what's going on in the political environment can have impacts on your portfolios. And I think that's exactly what you have the opportunity to look at here with your team at Cornerstone. But like one of the things, for instance, looking back over the last 40 years since 1980, right? Value has outperformed growth following in the 6 months following presidential elections. So on the 1 month, 2 month, 3 month, 4 month, 5 month, 6 month, 7 month, on average, value has outperformed growth by about 3.5% for the 6 months immediately following an election. Will that happen in 2025? No one knows for sure. I mean, past performance does not guarantee future returns, but that's maybe an opportunity that you could be thinking about or looking at, or that your team is looking at, right? Maybe there's an opportunity to overweight value a little bit or take some gains in the mega cap growth trade. And then the last one is, I think we all try to get a little caught up in, what's going to do great because so and so is the president, right? And so I just wanted to share the sector performance since 1993. We show you who's in the White House and the Congress, and then all these different sectors. And the first thing that I think is really worth pointing out is this number, right? The broader market does well, and most all these numbers are positive. But if you actually take the time, and we won't sit here and waste a bunch of people's time, but I can send these slides over to your team. But if you try and look at each of these, sector by sector, and say, oh, is it better? Like, it's all over the board, right? There really isn't anything that jumps out incredibly powerfully as far as like, well, if a Republican's president, I should own XYZ sector, or if a Democrat is president, I should own ABC sector. There isn't a huge correlation to that. It has so much more to do with the broader market conditions. So a couple things that I do think are worth pointing out, regardless of who wins, we tend to like things like financials, industrials, materials, and then tech, but in a more quality way. I think these are areas of the market that can perform well regardless of who wins this election. And we are generally constructive going forward in the market. Earnings are pretty good. We could see a little bit of rockiness in the economy, but overall, we've got a lot of headwinds or a lot of tailwinds as far as helping support equities and risk assets right now. Rates are high and they're going to come down in our opinion. Earnings look pretty solid. American businesses are doing well. There's a ton of cash on the sideline still. In our opinion, now is a great time to be having those conversations with your financial advisor when people are scared about the selection cycle, and just make sure that you've got yourself invested appropriately for your goals. And we think it's going to be probably a pretty solid couple of years here ahead of us, and we'll readdress this the next election cycle that comes. But overall, stay the course, continue to work with your advisor. It's the best way to protect and grow your wealth. Just sticking to that plan that you all have in place. So hopefully there's a couple helpful things here. Happy to take any questions. Thanks so much, Ken.
Thank you, Blake. Any questions at this time? Let's see here. We have mute. Okay, if anyone has a question, if you want to go ahead and unmute, or you can put it in the chat. We'll give a couple of seconds, but yeah, Blake, thank you so much. Great information. A lot of the stuff that we've been talking, we've made some slight moves already away from growth, not just reallocating a little bit more on the value side already. So definitely thank you for the information. I'm looking, I don't see anybody.
I think that means we nailed the presentation is what it boils down to. We answered every single question possible.
Someone, let's see, Jeff, Lupe, what are your thoughts on possible digital currency, Blake?
Yeah, great question. It's been on people's minds for quite a while. I mean, typically when this question comes up, people are asking about, Bitcoin, Ethereum, whatever. Our firm, we don't do anything specific from an investment in this side. Like you've seen some Bitcoin ETFs launched. We don't have any of those. Our opinion is that the blockchain in and of itself is a real technology, right? You can build things in these like smart contracts. There's a lot of application in our opinion for blockchain technology. But as it relates to digital currency, I mean, like right now, Bitcoin, Ethereum, whatever you have it, like there's not enough stability in those for this to be a real medium of exchange, in our opinion, right? And if it gets to the point where people are transacting with digital currencies, it's just first trust opinion that at that point the government will step in, right? I know people like this idea of like decentralized currency, like they can't take it, I own it, it's transfer. The government, can probably take whatever they want, right? And if they don't want to take the Bitcoin, like they could just start their own digital currency. So, I personally, and I'm not even sure my firm has done enough of the research to understand all of this. And I know that there's some people that are really, really well versed in this, but the broader idea that we at least come back with is there's nothing wrong with this. It's not that it's bad. It's just that if we get to a point where we're doing transactions in as much digital currency as we are US dollars, that the governments will get involved and it becomes less of this kind of decentralized rogue concept that most people really like digital currency for.
And I'll jump in a little bit there too. So in the studies that we've done as far as adding some sort of digital currency, most of them have been Bitcoin or Bitcoin plus type ETFs. That it has accentuated on the positive side and the negative side. So there's been, at least so far, zero diversification benefit by adding something. You're basically just getting higher highs and lower lows. And so from a diversification and ultimately when we're looking to add something to a portfolio, generally you want it to enhance the return in some way or bring the volatility down. And all we're getting is higher volatility and higher higher highs, lower lows. So far, it's something we keep a pulse on, but so far the numbers have not made sense to look at implementing really at any risk level for clients on our end.
Thank you. I don't see. All right, so Jeff is talking about implied effects of possible 3 wars. I know that could get pretty lengthy, but like, do you have anything short?
Yeah, so there's been a lot of global political issues going on basically since the Ukraine-Russia conflict that came out, and in our opinion, most of these wars that are going on do not have a major impact, at least on the investment side here in the US, right? I mean, I remember seeing something like it was like less than 3%, and don't quote me on this, I know this is recorded, so I'm just caveating. It was small. I want to say it was like less than 3% of revenue in the US was generated in Russia, right? So a Russia-Ukraine war, although there's social impacts and all that, we're sending them a lot of money. We don't love that, but the impacts of that on the investment market is pretty low in our opinion, pretty insignificant. The one place that could create more issues in our opinion would be a China Taiwan situation, right? The likelihood of that happening that we're seeing right now is not high, but that would be the one part of the world that we're kind of keeping our eye on, simply because of all the manufacturing and trade that we do with China. I mean, it's a massive economy at this point, and it's something that would have an impact if that got disrupted significantly. Now, we do actually think that what's happened in Russia and Ukraine and how that's been perceived at a global level makes China less likely to invade Taiwan, because it seems like kind of social suicide at this point. Like nobody seems to support Russia at this point on a global scale. So that would be the one benefit of kind of seeing how that's happened. But that's the main thing that we would have in mind, is just the China situation.
Thanks, Blake. All right, I don't see anyone else. Last call. All right, well, I'm going to turn it over to Andy to close us out. Again, thank you for everyone for being here. Thanks, Blake, and I'll turn it to Andy.
All right. Yes. Thank you again. Again, we understand everybody's time is very precious and valuable. And so the fact that you jumped on and spent 30, 35 minutes today, we don't take that lightly. And so with that being said, we also would love to get some feedback from you guys. Everybody that signed up for this, you'll get an email from us with a way to, a little survey to give us some feedback because we want to be able to get better at doing these and be able to more of them to you. But also part of that feedback is the ability for you to, follow up with any questions, regarding your particular situation, whether that's on your portfolio and what we're doing on that side, or from a planning perspective, if there's anything we can be doing differently or better, or any concerns you may have. So please just take the 2 minutes that it would take to fill that out. We'd greatly appreciate it. Yeah, we will wrap it up with that. But thank you all again for your time. Ken, great job. Blake, great job. Thank you again for coming on. Really do appreciate it. And hope everybody here has a great day.